Hi Boyki, good to see you again. Okay, sound looks good. Jayanti, maybe we need to adjust the volumes a little. Just give me one moment. Let me see if I can adjust the volumes. And could you also let me know the allocations? Right, can you see the Excel sheet? So sound and screen. Are you okay? Okay, all right. Let's go ahead and start. We are in time over here. Let's not wait. I was waiting for the other people to join in, but let's go right ahead. I don't have a PowerPoint or nor do I have a presentation today. I just want to talk off the cuff, discuss about money management. Right, let me start off with money management. Let this screen be over here. So we'll just talk about money management. For those of you who attended my last session, the last Thursday, we discussed the trading procedures. What is more important about the trading procedures? It's really not the technical analysis which counts. It is the other parts, something which I label as the 3 M's: money, mind, and method. Now, just briefly to recap what we went over last time is, if we have a trade plan, and you must have a trade plan, a very specific trade plan. Without a trade plan, it's very difficult to succeed because there are reasons for it. You need to have, like everything in life, in business, you need to have a plan before you start working on it. So you need to have a trade plan. The trade plan, your trade plan for trading, Forex markets, you may be trading Forex, you may be trading equities, commodities, derivatives, anything. It applies to any financial instruments that you're trading. Your trade plan must incorporate what I call as the 3 M's. Now when I talk about the 3 M's, it is money, mind, and method, necessarily in that particular order. Out of which, if you distribute a trade plan on a scale of, let's say, 1:10, then money management constitutes about 5 parts. The mind factor, which is your discipline and your patience to follow a trade plan, constitutes about 3 parts. The method, the technical analysis that we really look at, all of us, it constitutes only 2 parts. So technical analysis is actually the least important part of a trade plan. Not that it undermines the importance of technicals or technical analysis, but you need to incorporate the other factors also into it. Unfortunately, most traders, now I have been coaching for a number of years, I have been through the trenches. I have blown up a lot of accounts in my initial years. I know exactly, I can tell you what works and what does not work. Most new traders who come in, I have got traders coming to me for coaching, asking for help, or asking for solutions to problems. I have seen that most of them look at technical analysis only. And within technical analysis, they're just looking at indicators. I have always said that it is not a trader's fault, really. Today, if you go online and you want to start trading, you do a Google search, you buy a course, you purchase a book, everybody talks about indicators. It's very rare that you'll come across somebody who's talking about money management, your mind factor, which is very important. So when a new trader comes into the market, what he does is he looks only at technical analysis. Within that, he looks at indicators. So within the 2 parts of method, he is actually following only 0.5, I would say, out of 2, leaving the 1.5% of price action completely. So out of 100%, if a trader is following only 0.5%, it's not surprising that he or she fails. It's just very simple. Just my way of looking at things. And I have seen traders come even today, new traders and maybe even some experienced traders with the same issues. Right. So once we discuss about the 3 M's, I want to go over each of them one by one. So today we are going to go over money management. If we can finish one part, or maybe we'll continue with the second part. Now in money management, there are 2 points, as you saw in the brief, in the description of this webinar over here. One is your risk to reward ratio. The other is your position sizing. I would also include a third part, which is very important, but not many people talk about it, is capitalization of your account. You cannot start an account with $500 and expect to make money, because it's not going to work. Believe me, you'll end up giving up that money to the market. Minimum account, now as you can see over here on the Excel sheet here, let's just talk about mini accounts, right? Because I trade a mini account, and let me come down to, we're going to talk about this mini accounts. A minimum account equity, what I would recommend according to me, is $3,000 is what I would really recommend. Now, even though I may be having a larger size account, a pretty reasonable account with about $15,000-$20,000 in it, maybe $25,000 in it, I would still rather trade a mini account than a standard account, for the simple reason it helps me distribute my lots. So instead of taking one standard lot, I could take 10 mini lots and distribute my trades, try to take out profits earlier, try to get out of the trades, lock in some profits. It gives me a lot of flexibility. So we're going to talk only about mini accounts. Let's first talk about the position size formula, right? Now this is a standard formula which is available everywhere. I mean, if you do a Google search on it, I'm sure you'll come across. This is a standard mathematical calculation which all the traders follow and which is available everywhere. It's nothing to do with me. I have not invented it. It's a standard thing. But let's just look at the mathematics of it. Your position size says it depends on your equity. So for a mini account, it's E divided by 500 into bracket minus 1. Now I've just put it down in the Excel sheet. This is part of the Excel sheet which I give to my subscribers who subscribe to the mentorship programs or the courses or the live trading rooms. It is for them, and this is something which I follow even as of today. We'll just go over this briefly, but let me just show you this. Alright, so if you feed in over here, what I've done is I've just fed the formula. Now $3,000 in the yellow shaded area, this is what it is. Now let's say that for $3,000, if I have an account with $3,000, the formula says that I can trade a max of 5 mini lots at any given time. Now this follows the golden rule of never risk more than 2% of your entire capital at any given time. Now I have a lot of traders who ask that even if you have $3,000, it means you're risking only 2%. That means you're risking, let's say, about $600 out of the whole thing. Why are you keeping so much money with you? Aren't you reducing your profitability? If you risk higher, or if your positions are higher, a profitable trade would definitely give you a larger amount of profit. I agree with that. That's one way of looking at it. But another way of looking at it is, as a trader, my first priority is to protect my capital. I always say that a trader's capital is the bloodline. No capital, no trades. It's as simple as that. So I'm going to look at all kinds of factors to help me protect my capital. For me, risking 2% becomes live to fight another day. You must accept that you will have losing trades. There are no two ways about it. You may even today, I get a string of about 4, maybe 6 losing trades in a row, which is part and parcel of trading. It doesn't mean you're a bad trader. The market is too huge. Nobody can control the market. You will get stopped out sometime or the other. Even if you follow your plan completely, you do everything perfectly, the markets will still go the other way. This is the business of probabilities. This is what you have to accept. So the logic is live to fight another day. Coming back to this, if I have $3,000, I can trade a max of 5 mini lots. Now let's say that I start off with $500, right? Isn't this what we come across? You come across advertisements. I have seen advertisements about brokers saying that start an account with $500, work from home 24 hours, work in your pajamas, make money 24 hours, lots of money. If I start with $500, I can mathematically say that 0 mini lots is what I can trade with. Statistics do not lie. This is simple facts. Now, even if I go ahead with $1,000, I can trade 1 mini lot. Now, this is simple logic. It's mathematics. It's figures. Statistics do not lie. Let me show you something which you will understand much better and which will strike the point home. Just give me a moment. Right, let me get down to where is my alright, I've just switched applications. Can you see this website? Could you just confirm with me, please? Great. All right. Now, this is a free website. It's called Radioactive Trading. You can note it down if you want. You can do it. What this does is it is a kind of a simulation, right? It gives you prediction about what you may earn over a period of 100 trades, taking into account your profitability and your win-loss ratio. Now, let's have a look at the figures. Let me just go ahead with this and see what it is. They've got two factors over here. One is this target return, right? And second is your loss limit. Now, this is simply your risk to reward ratio. Now, if I have a target return of 10 and loss limit of 10%, it means my risk to reward ratio is 1:1. The other factor is your probability of loss. This 50, what's put down over here as 50, it is your win-loss ratio. 50 means out of every 10 trades, you would get 5 correct trades and 5 losing trades. So your win-loss ratio is 50%. Now let's keep this at 50% because I believe it's a pretty reasonable amount. For me, even today when we are trading, we also trade managed accounts. The average win-loss ratio that we are maintaining is about 60 to 70%, which means that out of every 10 trades, every 3 to 4 trades are wrong trades, are losing trades, and there's no two ways about it. I cannot expect to get 10 correct trades out of 10. I'm living in a fool's paradise if that's the case. Now, a lot of traders do expect that. As I mentioned earlier, it becomes an ego problem with a lot of traders. So let's keep this at 50%. I think it's pretty reasonable. You can at the most increase it to 60%. Let's increase it to 60%. That's the max. I wouldn't really go above 60%. Until unless you are exceptionally lucky or you are exceptionally good at your work, which I still don't believe because the market is too huge and you will get losing trades. But let's keep it at 60%. Right, let's have a look at the risk to reward ratio. We just had a look at the position size. What you must do, let's have a look at the risk to reward ratio. Now, if I keep my risk to reward ratio at 1:1, this is what it is over here. Let's go ahead with the simulation. I have a starting capital of $10,000. Now, if I simulate this, it gives me the average returns over 100 trades. Right? So let's just have a look at the first column, results summary out of 100 trades. Let's not look at the individual trade results. The second one is not really important. Let's simulate this. What you have is your ending amount after 100 trades is $298. Right? Which, would you really want to lose 95%, 90% of your capital? Let's do it once more. It's a random simulation, $994. Let's do it once more, $1,800. The point being, with a risk to reward ratio of 1:1 and the best win-loss ratio, I would really say this is the best win-loss ratio. I wouldn't even go up to 70%. You are not making money at the end of 100 trades. You are losing 90% of your capital, whatever you do. This is computer simulations, of course, it's random simulations, but it's based on a certain method. Let's just do one small change. Let's make the risk to reward ratio at 1:2. Right? So my target return is 20, my loss is 10. So my risk to reward ratio becomes 1:2. Now let's do the simulation. Wow. $469,000. Man, I'm a millionaire. Let's give it one more simulation. Let's see how many times does it really give us. $26,000, which is still twice the capital, which is good. There's a minimum, I suppose. $6,000. Oh, this is not good. $6,000. 1,000. What's wrong with this one? $148,000. $2,600. $46,000. Which means that I have a probability of doubling my amount or at least making profits. Most of them are above 10,000. Let's do one more change into this, right? Let's make the risk to reward ratio 1:3. Target return 30%, loss limit 10%. Let's simulate this. Oh, 4 million. Let's give it one more. 103,000. 1,956,000. 1956. 449,000. You can see the difference over here. Now this is just to drive the point home. Believe me, this is very, very important. I just wanted to put this across. You can do your own simulations over here, look at the results and see what. We are not going to go to anything else, we're just looking at this. Right, the point being, if your risk to reward ratio is more than 1:2 and if your position sizing is correct, these are the only two factors you need to succeed. And believe me, if your money management is correct, your technical analysis may not be correct all the time. Your probability of loss, let's do one more. If my risk to reward ratio is 1:3 and let's say I get 4 winning trades out of 10, I have 6 losing trades out of 10 every time. I'm not a very good trader. My technical system is not very good. But let's do the simulation on this one. I am still making money. And this is, wow, 4 million, more than that 4 million. I'm a millionaire. I should open a Swiss bank account sometime over here. Wow, 2 million, more than 2 million. 1 million. Now let it come down. This is going a little too much here. Let it come down. 37,002. Oh boy. This is still there. The point being, if your risk to reward ratio is correct or more than 1:2, even if you get more losing trades, your account will still grow. And believe me, this is a fact. I have seen it, I have been following this, and I can assure you that this is one of the things. Let's get back to the Excel sheet and let's drive home the point once more. Right, all okay so far? Voice okay, everything okay? Well, as I said today, I don't have any PowerPoint. I just want to drive home the importance of money management. Where's the other one? There you go. Okay, back to the Excel sheet. Are you clear on the Excel sheet? Can we see the Excel sheet? No? Oops. Just give me a moment. What's wrong? Okay, there we come again. Alright. Alright, so position size formula. You need to start an account. Your capitalization has to be correct, minimum of $3,000. Then you can go ahead and trade with a minimum of 5 mini lots. Now let's just go over two things. One is your position sizing based on your formula. Second is your risk to reward ratio. Everything in trading is tied to money management, right from your technicals, the analysis. Oh, the Boyki, that is a standard formula. So for a standard account, it's E divided by 2,500. For a mini account, it's E divided by 500. For a micro account, it's E divided by 500. Somebody else has invented it. -1, that's right. So E divided by 500 into bracket, the entire thing -1. That's a formula. Now, if you want, I can send you this Excel sheet with the formula. You need not. You can just go ahead with this. Not a problem. All right. This particular position sizing, because what I have done for my traders, I have put in a position sizing. I have put in leverage. Understand what leverage is all about. This is because the leverage is often a very misunderstood concept. And then this is something, as I said, I trade with myself. I still, whenever I take a trade today, I use this Excel sheet for myself. I take time off, I fill up this Excel sheet and see to it. Just for example, now this is reserved only for the subscribers, of course. But just as an example, let's say that I have a starting capital of $10,000. This 10,342 was from another trader of ours who's in the room, and we were calculating this. He was looking at a GBP trade or GBP buy. So we fill in this. Your price is 1.5850. This is what you're planning to buy it at. Yeah, sure. Just give me your send me your email in case you people don't have. Of course, you have my email, but I'll just put down my email over here. If you can send me an email, I'll send you the Excel sheet, at least for the position size formula. Right? So I can give that to you. It's a standard thing. It's available everywhere. I've just fed it into the formula. Coming back to this, so what I do is, if I have a capital of $10,000, for my trade, my stop loss is, let's say, 30. My profit target is 50. and my spread, take into account the particular spread, it gives me the risk to reward ratio. So it is 1.67. If it is less than 1:2, I do not take the trade. Now that's the mind factor which comes into it, which says that if the trade, it's looking good, the technicals are looking good, and if it does not conform to my money management principles, I will not take the trade. The second part is based on this requirement or based on these parameters, I have the number of position size over here, lots that I can trade. Accordingly, if I have $10,000, I could trade 19 mini lots. But what is more important is the maximum risk of capital. Let's say that I go ahead with 19 lots. I'm just showing you something. If I go ahead with 19 lots, my maximum risk of capital goes to 5.88%, which tells me don't trade. I need to keep this at 2%. So I reduce this. If I put it down at 5 lots, that's a max that I would probably take. And this is, believe me, I do this for every trade. This also calculates automatically the leverage over here. The leverage, the margin is carried forward, the leverage is related to the margin, so it's all interconnected. Anyway, as I said, I just wanted to show this to you. What I want to discuss more over here is related to money management. Your capital is related to your trading capital is money management, risk to reward ratios, position sizing, even the time frame that you are trading in depends on your capital. You see, you do not choose your time frame. Your time frame should be decided by the amount of capital that you have. Now, to go ahead with this, it's a very important concept which a lot of traders again do not look at, and regardless of the capital they have, they select the time frames, which you should. Right? If you're a day trader, you have time, you're sitting in front of the computer throughout the day, you can day trade. You go ahead and trade on the 5-minute and the 15-minute. If you're doing something else and you are a longer term trader like I am, I would rather trade on the 4-hour and the daily. Minimum to the 1 hour. I generally don't go below the 1 hour. I decide this, I need to have that much amount of capital. Let's do some simple calculations based on the trades, a couple of trades, 2-3 trades that we had taken, and I just want to show those to you. Right? Can you see the charts? Okay. All right. Now let's have a look at this. Now this is a daily time frame. Let me start off with the daily time frame, and I just want to correlate your technicals to your money management. This is a bearish harmonic pattern on the Euro USD on the daily time frame, something which we took short. Right now, this is a trade that we took was short. Just give me a moment. It was this. Oops. I need to change the color of this one. I need to put a dark blue color. Yeah. This was a short that we took. Alright, this was a short. Now, after this price went up, but I've kept this chart image over here because there's something which I wanted to show it to you. So, clear all annotations. Go. Right. Let's have a look at the risk to reward ratios of this one. Your risk on this trade, the entry was, let's take it at a round figure. Round figures on a longer term time frames do become important. 1.3060 was your entry into the trade. The stop was at 1.3140. Right, so we are talking about a stop loss of 120 points, correct? Roughly. So, no, I'm sorry. We are talking about a stop loss of 80 points. Let's just do these calculations. 80 points is your stop loss. Now your expected target, this is your harmonic patterns are based on the Fibonacci ratios, and this Fibonacci ratio was, the target was 1.27, a flip projection 127.2. Let's keep it round as 1.2700 round. The 127 was at 1.2711. So 1.3060 minus 1.270, right? You had a profitability of 360 points. What is your risk to reward ratio? 80 was your risk, your reward was 360, which is close to 1:5. Now this is one more thing. If you have trades which give you a risk to reward ratio of more than 1:3, you can see, you saw on the simulation, you just keep trading that, you'll probably become a billionaire, right? That's what the simulation says. Right, Jeremy, I'm just coming down to that. How do you know which time frame to trade with less than 200? It's all on these mathematical calculations, the capital that you have. Let's take this particular example. What was my stop loss? My risk to reward ratio was good. This trade went good. We made good money. It's never really a question of money. Everything was as per procedure. The trade went very nice, right? It was an excellent trade. Let's concentrate on the stop loss. My stop loss on this was 80 points. Now, we generally go in with multiple lots. I would recommend 3 lots as a minimum. You should never go in with one single lot, because it does not allow you to maneuver your money management positions. So if I'm going in with 3 lots, I have single lot of 80. So my total risk is about 250. Now let's say that I had $10,000 in my account. $10,000 divided by 240, let's say it's 240, my total risk on this was about, what, 2.4%? Am I right in my calculations? Right? Which just about fits into this. Which means, now this is where I'm coming from, Jeremy, that if I'm trading on larger term time frames and I have to keep a stop loss of 80 points into 3 lots, let's say my total risk is 240, I need $10,000 to trade on these larger term time frames. 2% of $10,000 is 200. My risk here is 240. It just about fits in. Now you do the calculation, Jeremy, that if you have $2,000, what is 2% of $2,000? 40, right? We would say 40. So your total risk is 40 points. If you divide this into 3 lots, I would always recommend going into 3 lots. I'll just come down to that point, which means that your average stop loss for your trade is about 15 points. Into 3 lots is about 45 points. 45 is 2% of your 2,000. Now 15 points is a very small stop loss, which means that you have to trade on a very small term time frame. Again, isn't it related to your risk to reward ratio, that if I have a stop loss of 15 points, my minimum target should be at least 30 points? That means I need to trade on at least a 15-minute time frame. Can you expect 30 plus points on a 5-minute time frame? Maybe you can, stretching it. So 15-minute time frame is ideal, where you can get a profit of 30 points, which justifies your 15 points stop loss into 3 lots, 45 points, which is 2% of 2,000. Correct me if I'm wrong. I'm just off my head. I'm just going it with these calculations. Right now, this is very important, folks. Jeremy, it is good that you asked the question, because I wanted to come down to that. If you concentrate on these factors, relate everything to your money management, believe me, you will see a difference in your account. You have to follow the correct principles of money management. Your technical analysis is not important. Now, of course, as I said, it doesn't undermine the methods. In fact, I had one trader who, in one of the sessions, and in fact, I was in the US here. I was in Miami, where we did a workshop in Florida. And we were going ahead with these same principles, and one of the traders, after that, when we were sitting for drinks in the evening, he came across and said, if we just follow money management, then you really don't need technical analysis, do you? I can trade on the toss of a coin. Heads I go long, tails I go short. I said, yes, you can. I mean, it's a fact. If your money management is correct, you can literally go ahead with heads I go long, tails I go short, and your account may still grow. But then we don't want to do that. We are traders. You're not gambling over here. I have always said, treat trading as a business, as a complete business. In the business, give yourself the perfect edge. Give yourself the edge which gives you or puts you ahead of other traders, the amateur traders. And for the edge, you need to get all the factors in your favor, which includes technical analysis. Right, let's go ahead with one more example. Let's have a look at this one. This is another trade, a divergence that we took on the Euro JPY on the weekly. Right now, simple fact is divergence. For those of you who are not familiar, bullish divergence. I have one student over here. She's very familiar with divergence and she's been trading divergence for so long. Susanna, I hope everything was good with the divergence. Right, so this is a divergence. This is a bullish divergence where price makes a low, lower low. Your stochastics or any oscillator for that matter makes a low and a higher low. It's a classical indication of a change of trend. Mind you, it's an indication, it's never a confirmation. Your confirmations come with price action, with Fibonacci ratios, everything. It's a trade plan. Your stochastics are just identifying the divergence, the setup. After that, you come down to price action, Fibonacci's, and everything depends on price. Anyway, let's get down to this. So this is a bullish divergence. We enter the trade on the weekly, right? At this stage, 9700 round. Let's make it round again. Your stop loss was at 9400. Your expected targets of the divergence, again based on the fibs, was 103.60. Now, what is your risk to reward ratio? Your risk is 300 points. Your expected profit, I said this one went, there are some trades which may not go all the way. Your expected profits was 600 points. Risk to reward ratio of 1:2. Fits into my trade, took it. Now let's concentrate on the money management part of it. Coming back to Jeremy's question over here. My risk here was 300 points. If I'm going ahead with 3 lots, that means my risk is 900 points. If I have a risk of 900 points, folks, how much money do I require if I'm going to risk 2% of my account? Come on, mathematics, give me an answer, somebody. Or do I need a calculator to do that? About $35,000, $40,000? Am I right? $40,000 into 2% is $800. Here my risk is 900. So which means ideally, as per the rules, you need $40,000 to trade on the weekly time frame. Alright, we have a question. Hesh, it's a very interesting question. Let me come back to it. Let me finish what I am doing. I'll come back to it. It's worth discussing. Right, so if I'm trading on a weekly time frame, folks, and if I need to keep a risk of 900 points, 300 points into 3 lots, I need $40,000 in my account. Do I have $40,000 in my account? In my personal account, I don't have $40,000. I'm not so rich. Well, I have most of my money stashed away in a Swiss bank, of course, so I don't trade with that. Just kidding around. But $40,000 is a huge amount. Right, so always tie up your capital to your time frame. Your trading time frame, what you're going to trade with, is dependent on your capital. Let's take one more example. I don't trade on smaller term time frames, but just wanted to show you this. This was one of our traders went ahead with a 1, 2, 3. It's a bearish 1, 2, 3 trade on a 5-minute time frame. This is classical 1, 2, 3. Now, one of the sessions we'll be having subsequently is the correct use of Fibonacci ratios. Let me just give you a heads up on this. We use the Fibonacci fans to confirm a 1, 2, 3. For those of you who are not familiar, I would suggest just read it up a little, do a search on it. It's one of the most important, one of the most simplest and yet effective trading patterns. I call the 1, 2, 3 pattern as the DNA of price action. You will find 1, 2, 3 patterns everywhere because price moves in waves. So we use the fans to confirm a 1, 2, 3. So this was the confirmation. This was a bearish 1, 2, 3. Right? Let's go ahead with this. This was your point 1. This was your point 2. The pullback which stopped to the fans was your point 3. Now, based on the parameters that we go ahead with trading the 1, 2, 3, again based on your Fibonacci levels and etc., we enter the trade at 1.602. Your stop was 6028 on a 5-minute time frame. Very frankly, I will never be comfortable with keeping a stop loss of only 8 points. It's no point because price will definitely take you out for no rhyme or reason. You cannot keep a stop loss of 8 points. I mean, the price will just whipsaw you out. This one, of course, went down good, but doesn't happen most of the time. But for theoretical sake, for calculation's sake, let's take this. I have a stop loss of 8 points. My expected profits based on the calculations that we do based on the Fibonacci expansions, this was the expected target. So this was 6005. I had a profitability of 15 points. Risk to reward ratio was exactly 1:2. right? Risk of 8 points, reward of 15 points. Fits into the parameters. Now let's take this, your 8 points stop loss. Into 3 lots, 24 points. 24 pips. Let's trade a mini account where 1 pip is $1. I'm just talking about mini accounts. So your total risk was 24 points. Now Jeremy, coming back to your question. If you have $2,000, 2% of $2,000 is $40. This trade fits perfectly into that. Your risk over here was $24 theoretically. Right, so with $2,000 you cannot trade higher than a 5-minute time frame. So even if you have to, and one more thing, let's correlate this once again. Your expected profit, as you can see over here, was only 15 points. Now the minimum stop loss that I would keep on any trade would be at least 15 to 20 points. You give price some breathing space, right? You don't want to keep a stop because you'll just get stopped out for no rhyme or reason. You have to give it some breathing space. Take into account some higher spreads. All the brokers tell you the best of spreads in a live account. Believe me, folks, unfortunately, Forex is still unregulated. Your broker can increase the spreads. He will not give you the correct fills. Keep into account those things. So if I'm keeping a stop loss of minimum 15 to 20, let's say 20 points, my expected profitability should be at least 40 points. Can I get 40 points on a 5-minute time frame? I cannot. Which means I have to go to at least a 15-minute time frame. So minimum stop loss or minimum trading parameter for me is a 15-minute time frame with a stop loss of 20 points into 3 lots, that's 60 points, which means I need to have about $3,000. 2% of $3,000 is 60. This is the reason why I have arrived at the figure. I have arrived at this figure of 3,000, that you need a minimum of $3,000. Now with this, let me point out one thing. If you have $3,000, you're taking a trade with a risk of 2% of 60 points, 20 points into 3 lots. You cannot take any other trade till this trade is finished. If you come across another setup which is a good setup, you cannot trade that. Ideally, you should not. It's not that you cannot. You can do whatever you want to do. You should not, because it's going against the rules of your money management, which simply tells me that I should have at least another 2,000 or 3,000 spare on top. In case I see some other setup, I need to have something to take that possible trade with me. Right, so this is the importance of money management, folks. Always try and correlate all your money management to your technicals. I hope I have driven home the point about the importance of money management. Believe me, most of the traders, and believe me, 80 to 90% of the traders do not consider this factor at all. No, Jeremy. Profits are taken out in between levels, which what happens is that you will never get the ideal 1:2 risk to reward ratio. Right? Let's take the example. That's a good question. It's worth discussing. Let's take this. Now, if I'm taking this, what we do is, it's such a huge profitability. Of course, it's the daily time frame. This brings me to a question of trading on higher term time frames is much more important. You would take profits. We do take profits. Now, let me just give you some clues about it. 78.6 is a very, very important percentage. So what we do is we treat the 78.6 as one of the first lots. So out of the 3 lots, when price reaches 78.6, it's usually expected to retrace from there, which it does normally. As you can see, it was very close to 78. We close 1 lot at 78.6. And at that time, I shift my stop to my entry, which says that I am in a free trade at that time. I have taken profits of 1 lot. If price goes against me, which it can, I have walked away from the trade with 1 lot of profit and no loss, because my stop loss level is at my break even. Now this makes a lot of difference for 2 reasons. One, psychologically you start breathing easy, because when your money is on the line, believe me, your hands start sweating when price goes against you. It happens to everybody. Once you've already locked in some profits, you think properly. You have a very logical approach to it. That makes a lot of difference. Secondly, you've already locked in profits. And as I said, as a trader, my first priority is to protect my capital. My risks have to be 0. This is where my capital is protected. Subsequently, if price goes further, we lock in some more profits. That's the reason where when I say that 1:2, if you're taking profits in between, your profitability will never come to exactly 1:2. It will be less than that because you're taking profits in between. But when you're calculating, keep it at a minimum of 1:2. You can imagine if you go in with a risk to reward ratio of less than 1:2, that means you're at break even. Which is one of the reasons that patterns that we trade, I have showed you two patterns over here, the harmonics and the divergence. We also trade the wolf waves, the hidden divergence. Each of these patterns give a minimum risk to reward ratio of 1:3, maybe even 1:4. And you have seen the examples right over here. Now, I have devised these methods, or I concentrate on these particular patterns only because of the higher risk to reward ratio. 1:2 is acceptable, but I would rather take a trade with at least 1:3. So which means I need a good technical pattern. Which means I need something like the harmonics or the divergence, which will give you 1:3 and above. Alright? I hope this answers your question. I think that's about what we had done for the day. As I said, it was just no presentation, nothing. I just wanted to, I hope you've listened to it. I still come across traders today. Most of the traders are still making the same mistakes. My intention over here, I have always said that it has been my endeavor on FXStreet is to show you the correct path. Now, it's never a question of you take my technical analysis, you take my course. Now, you're free to do whatever you want to do. I'm the last person to say that. But whatever technical patterns you're trading, I would suggest please incorporate these methods, these procedures into it, and you will see a difference in your trading, believe me. Alright, folks? So tie up everything to your money management. Once again, most traders do not look at it. I don't want you folks to become just mere statistics in the market about the 85% of the traders who lose money. You are experienced traders. You are here for a reason. You are here to learn something. And I hope you can implement these to improve your trading. Alright. Alright. Any questions? Of course, just let me know, and let me come back to the question of hash. Alright. Effect of time frame, news in short-term money management. Additional risk factor, yes, hash. See, news is something I don't personally trade. I find it very risky. I find it like gambling. I would rather take a technical setup where I see my techniques. Chasing price after news, you may probably get some good pay out of it, but you would end up losing most of the time. And in any case, with a trade plan, until and unless I don't see the plan before I enter the trade, I would not enter a trade. So first factor is news trading is something I don't do, which I would not recommend. Secondly, tying up money management to it, yes, this is definitely an additional risk. You must take into account this particular risk. Either you close off your trades before an important news announcement if you're in a trade, or if nothing else, at least shift your stop levels to your break-even point. So at least your capital is protected. I completely agree with you, Carl. That is why the mind factor is very, very important. Believe me, it's not easy to sit there, and it's natural. You're sitting there the entire day and you don't get to trade. It's very difficult to sit on your backside, not do anything till your setup arrives. You may not get a trade for 1 day, 2 days, 3 days. That is a self-control which is required. And trading, I have always said, is you against yourself. You're trading other traders, but you are fighting with yourself, I would say. If you can control yourself and you can get your emotions in place, you will definitely make a good trader. So your mind factor and money management, you just proved the point, is more important than your technical analysis. Once again, doesn't undermine the importance of technical analysis. But your discipline, your patience, if you have these three factors into place, you have it made. You are definitely among the top 10% of the traders who will make money. Alright folks, great being over here. I do hope that this has opened your eyes in some ways about the effectiveness of money management. Once again, if you have any questions, questions, please feel free to send me a mail anytime. I'm always here to answer it. And I'll see you next week for another session of, well, the practicalities of trading is what I would put it on. Hesh, that is exactly the point when I say that when you do one trade and you lose and again you lose, that is where your 2% comes into handy, right? How much can you go up to? I would say you can go up to 10% of your capital, maybe even 15%, which means that you can get up to 5 to 6 losing trades in a row. And it does happen today. After that, if you still get losing trades in a row, then there's something wrong. You're not doing something correct. Then you should reanalyze your approach. But the whole point about 2% is that even if you have 5 losing trades in a row, you have lost 10% of your capital. You still have 90% left with you. But that is exactly the point of the 2% rule. Okay. Jivesh, what would be in Euro USD today? Haha. Jivesh, you will have to pay me for that. How much are we going to pay me? Are you going to give me a 6-pack of beer? Then I'll tell you what's going to happen in Euro USD today. Well, seriously, I don't believe in looking at technical analysis in the sense giving trading signals. Right? I believe more in the procedure. I have my own trading systems. If Euro gives me a setup, I trade it. I don't care whether it's going up, whether it's going down. I don't care where it's going to be 1 month down the line. It gives me a setup today, I take the trade. I'm a trader, I'm here to make money. I see my setup, good odds, good probability, I take the trade, I get out of it. Period. No, Shesh, I don't think so. Right? Luck factor, see, the market is too huge, you cannot control it, I understand. No, it's a good question, because there are a lot of people who say that I'm not lucky in the market, but I have always believed that you make your own luck. Right? Opportunities come to those who are prepared. And luck has got nothing to do with it. The more prepared you are, the more luckier you can get. That's what I believe in. Alright. Alright, folks. So, always a pleasure being over here. Alright, George. Thank you very much. I will see you next week. Hesh, could you send me an email? Because I'm not sure whether I'll be able to get it from here from the chat. Anybody who wants, you have my email address. Just send me saying request Excel sheet. At least the position sizing and the leverage and margin, that's standard thing, which I'll send it across to you, not a problem. And if you want to try the entire Excel file, as I said, it's exclusively reserved for the participants, for the subscribers of the mentorship programs, the courses, because this is what we teach over there, that you're supposed to use your money management, and if you learn the methods, this is how you're supposed to use it. Alright, so I'll see you folks next week. Thank you very much. Always a pleasure being over here. Have a good trading week.